What's up, guys? Inflation is here, and a lot of you have been asking, how do I invest my portfolio in an inflationary environment? That's what we're going to cover on this video. You're watching More Money. Let's get it. Welcome back to the channel, guys. As you can see, we got this new standing studio here. I'm gonna use this studio more for making intros and to answer Q&As. And I wanted to hit it off right by doing the very first Q&A as soon as I could, so here we go. A lot of you guys are concerned about the levels of inflation that we're seeing in the economy right now. What you guys may not have realized is that the value investing community has actually been worried about inflation since 2009 when we first started doing quantitative easy. So the fact that inflation is finally here shows that we couldn't really avoid the inevitable as much as we thought that we could. So I got 4 ways that you can hedge against inflation, but before I get into it, guys, if you can please smash that like button, it really helps YouTube know that this channel provides valuable content. Also, if you're new, please subscribe to the channel. There's all sorts of good stuff on here. All right, guys, the first way to hedge against inflation is by using what's called the debt asset liability spread. So the way this works is if you were to just borrow $100 and then pay that $100 back a year later, if the rate of inflation is expected to be 5%, what you've effectively done is you've borrowed $100 today and you're paying back $100 a year from now, but that $100 a year from now is worth 5% less because the rate of inflation is 5%. So you've effectively borrowed $100 and you're paying back $95. Now, if you were to add the rate of interest on there, the rate of interest generally is about 1.5% right now. On a lot of real estate loans, it's actually less, but if you were to just borrow at 1.5%, you're effectively paying back $95 in real dollars plus 1.5% interest. So 96.5, you're still ahead. So that's what I mean by that debt asset spread. The rate of inflation is higher than the interest that you're paying on the debt. That's always going to net you money. Now, the other thing that you can do to further juice your returns is invest that cash that you borrowed. So you don't just borrow and put it in a bank account and wait to pay it back a year later. You invest it in something. What a lot of people are doing right now is that they're borrowing money and they're investing in real estate. If real estate is going up by 5%, then at the end of the year, if you were to purchase that real estate outright with cash, you would have made 5% on that capital, plus you're paying back debt that's 5% less value because of inflation. So you're up 10%. Subtract the interest rate, 1.5%, you're up 8.5%. Now, to even further juice that, a lot of people don't invest in real estate without a mortgage. So if you're doing a 20% down on your mortgage, well, now you've multiplied your return on your asset by 5 times. So what would have returned 5% is now returning 25%. So that's how you play the debt asset spread. Now, what you need to be careful of is you need to be a long-term investor if you're going to play the debt asset spread. Property prices may very well be juiced up right now. So you're buying in a historically high market. So if you're going to buy a home, be sure that you're able to live in that house even if the property values decline by 50% or more. It could happen. We have seen it happen before. You just have to be able to ride it out. Now, at the end of the day, you need somewhere to live. So this might be a good opportunity to purchase a home if you haven't already. Now, keep in mind that home values may decline over the short term. In Canada, at least, I think we have the tools to address that. In the US, I'm not so much of an expert, but I think it's a local by local issue there. The second way that you can hedge diversification is through equities. Now, not just any equity makes sense here. Any company that's not generating returns right now and are expected to generate cash in the long term, their valuations are going to hit the largest if we have to increase the rate of inflations in our models. Now, a lot of us are already using 5% rates of inflation in our models, but not everybody is doing so. So you are going to see valuation contractions with a lot of the growth type names, the technology names that are not necessarily earning cash right now. So there's 2 things that I want you to look at when you're looking at equities. The first one is, do they have a lot of debt? What you're really looking for is companies that don't have a lot of debt. So as the rates of interest go up, because we're seeing inflation, the companies that don't have much debt, their business doesn't materially get impacted. The second thing that I want you to look at when you're purchasing equities is, do the companies that you're purchasing have pricing power? So do they have the ability to push price increases onto the consumers? A lot of companies that operate in food, in very value-added services, etc., will have that ability. So make sure that the company that you're investing in has that capability. What we're seeing a lot of right now is a flight to quality into those types of companies. There are companies in the tech space that do have those economics. For example, Apple, Facebook, Google do have those economics where they can push price increases from inflation onto the consumer. So keep that in mind. The third hedge against inflation, you guys already know, is physical commodities. So you can obviously purchase physical commodities like gold and silver and store it away. You can also purchase them on the stock markets with physical ETFs or commodity producers. The one thing that you guys may not have heard of, which is very interesting, is you can purchase fractional ownerships of productive land. So for example, farming land, which is then leased out to farmers who pay their leases in order to produce on that land. So that option is available too. I'll put some links to ticker symbols in the description below, but you do have the capability of being a fractional owner of productive farmland in America. Now I'll quickly touch on crypto. I personally look at Bitcoin as the winner in the crypto space. I look at Bitcoin as a store of value, not as a network. So in other words, I have to value Bitcoin relative to something. And so as explained in the previous video on Bitcoin, I value Bitcoin at approximately 5% of the total value of gold and silver. It's currently trading at about 5% of the market cap of gold and silver. So it might not be a bad entry point into Bitcoin. However, if I was encouraging someone to buy Bitcoin, I'd say wait until it's around 2.5%. So I'll leave that there. If you believe that Bitcoin is more of a network, then its value is $250,000 a coin plus. So Kathy Woods definitely looks at Bitcoin as a network. I personally don't, but she's buying, I'm not. So we'll leave it at that. The third hedge against inflation is get out of the country that you're investing in. Guys, there are stocks that trade outside of North America, especially in the East. China has a lot of good companies, and I know people don't necessarily like to invest in China. I get the risk, but there are some very valuable companies there. Overall in the East, you're going to benefit from three major things. One, you have better productivity. Two, you have higher yields because valuations are lower because people are hesitant to invest in the East. And three, you have a better future economic outlook. Now, a couple of great companies that I'm going to cover on this channel are Alibaba, JD.com, and Pinduoduo. Those are online realtors in China. Now, my Patreons are going to know one company that I've personally purchased for my portfolio is Alibaba. It's now approximately 15 to 17% of the portfolio, and it's the largest position next to cash, which dwarfs it, of course. I've been buying that around $210 a share, and I'll continue to buy it if it continues to go down. Now, your fourth hedge against inflation are Western businesses that have the characteristics that I described for the stocks and who have exposure globally. So look at the Western businesses that earn their income globally. So your Apples, your Googles, your Facebooks, your food companies like Kraft, etc. If you have Western businesses that are earning a substantial amount of their income globally, then they're globally diversified and they're not really tied to the economics of one domestic area. So that's another way that you can hedge on inflation. And if you're noticing, a lot of the smart money is going into these stocks right now. So be careful, valuations may be really high. All right, guys, that's it for this Q&A. If you found any value from this, please hit that like button. It really helps YouTube know that this channel provides valuable content. And once again, guys, please subscribe to the channel so I can continue bringing you guys serious value. You've been watching More Money. I'll see you guys later.